Hello, in this lecture we're going to define the term of prepaid expense. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of prepaid expense is items paid for in advance of receiving their benefits classified as assets. So key points here is that we are paying for something before we're receiving the benefits of that something that we are paying for. This is why we are going to record the prepaid expense even though it says expense in the term as an asset, because it's a prepaid expense, meaning we paid for the expense before we have consumed something. Let's take a look at some common examples of a prepaid expense. The most common example is prepaid insurance, in that whenever we buy insurance, by definition, we are paying for the insurance before we are receiving anything. The only thing we have received is a policy, which is basically a promise to cover us in terms of insurance in the future. But until that coverage is taking place, until that risk is taking place, we should be recording the prepaid expense as an asset because it's going to provide a future benefit. It hasn't been consumed at this point in time. As that benefit is consumed through the use of the policy, then we'll move it from a prepaid expense, an asset, to an expense on the income statement, reducing net income at that point. Other examples of prepaid expense would be in terms of a rent. If we're renting something, we may pay for something in advance. For example, we may pay 6 months in advance for renting of a forklift. At the point of time that we pay for the rent, we haven't consumed the use of that forklift for the 6 months. We just got the forklift. Therefore, when we pay for it, we want to put it on as an asset rather than expense. And then as the time passes, each month that passes, we want to record the expense as that time passes. You can see why this would be important, because if we did not do that, if we paid 6 months of cash in order for a very expensive forklift that might be a substantial part of our income statement, if we just used the cash method and expensed it all in month one, what would happen is our net income would be lowered by that 6 months worth of rent, and the next month would have no rent allocated to it at all because we prepaid the rent. And that would be a distortion. If we were comparing one month to another month, we might be misled by the fact that all 6 months worth of expense would have been recorded in month one and not in month 2, 3, 4, 5, or 6. That's the reason we need an accrual basis. In this case, that accrual basis applying the rent, in this case, over the 6 months, the time period in which we used the equipment in order to help us generate revenue, allowing us to match the income statements over those 6 months and see what the actual performance was in a better way.